What is going on, everybody? Hope you've all been having an absolutely fantastic day, and welcome to episode 6 of the Forex Bootcamp, where we're going to be looking at technical analysis part 3. So, what are we going to cover in today's episode? Well, we are going to look at candle formations, we're going to look at wick rejections, the difference between push phases and pullbacks, we're going to look at patterns, and then we're going to be looking at those ever scary indicators. So let's start off with candle formations. So we've already discussed about candlesticks, and you guys are very familiar with them now, at least you should be after looking at TradingView and watching this content. And one thing that you probably have noticed is the different sizes between all the candles. And so this is what I like to call candle formations or candlestick formations, okay? Because the ranges of candles can be different, the sizes of them can be different, the size of the wicks, and this is all painting a very important picture for you. So if I just go through a bunch of examples, okay, I've added some little key pointers to either side of the screen there, but I want you guys to get your notepad out and I want you to just be making some notes on what I'm saying. Okay, if we have a very large candle with almost no wicks at either end, then what this shows is that there's potentially going to be a lot of momentum that's coming into the market. Okay, if we've got, say, a big green candle and we've got like absolutely no wick either side, then it's just showing you that all it wants to do is push. And it's the exact same situation if we're looking at a bearish candle. Okay, let's assume now that there is a really big candle, right? But there is a really long wick coming from its tail end. So if we're looking at a green candle, then the wick to the bottom side is very, very large, and there's almost no wick to the top side. Then this is showing you the exact same thing. Okay, it's probably not as strong because price did push in the other direction first, but it is basically showing you there is a lot of momentum. So something like the top right candle, okay? If we, however, kind of have just, if you look at the candle to the bottom left, it's not sort of perfectly drawn, but if we have maybe like a smallish candle and there's kind of wicks either side, then this is showing us a little bit of indecision. If we look at the candle, which is third to the right at the top, this is showing us an even bigger sign of indecision. Okay, we've got to look at the size of the wicks, we've got to look at the size of the candle, and it's all showing us something. Bigger candles means that price was pushing in that direction, whereas smaller wicks basically showing that price really wasn't moving that much in that direction. Okay, so bigger candles mean that we typically have, more momentum that's coming in. Smaller candles mean there's probably not that much movement. If we don't have any kind of clear direction as to where price is going based off the candle sizes, so for example, if we take a look at the second candle on the bottom side, this is a bit of a weird one. I don't really know why I drew this in, but I think it's just showing you how awkward they could kind of look. So if you saw this one on your chart, you'd be correct in saying to yourself, well, price did push down for a certain period of time and then it shot back up. So this might be telling me that price is looking to push upwards, but it did leave this very small body, so it's a little bit undecided. You'd be very correct in saying that. And the truth of the matter is that you're never going to get a perfect you're never going to simply get the perfect answer. Okay, you could see something like that, and it could even be a bullish candle, a green candle, and you might still get that same bit of information. If you look at the second candle at the top, something like this, where this is what's called a hammer candle, but you don't really need to know too much about the names of them. You can clearly see that price had pushed up, and now it seems to have not broken, but started pushing to the downside, where the momentum looks like it's more so going down than up. Can you see how there's not much wick to the downside, but there's a much larger wick to the upside? This is where price is showing you that price has pushed up and it's come back down, and because it's also closed bearish, it's showing you that we're likely to go in that direction. Okay, typical rule: the bigger the candle with the least amount of the smallest wicks is showing you a lot of momentum. As the wicks are getting bigger, if it is to the tail end of a candle, and what I mean by tail end is that if we're looking at a green candle, it's the bottom wick. If we're looking at a bearish candle, it's the top wick. Okay, if we have a large candle with also a large wick at the tail end, this is also showing momentum. Okay, but if we have a large candle with a large wick either side, then it's potentially showing you that it's undecided. if we have a large candle and there's a large wick at the, say, head of the candle, which is for a bullish candle, it's the top part, for a bearish candle, it's the bottom part, then what this could show you is that even though it's a big candle, the wick is showing us some kind of rejection. Okay, if we've got a small body, then it's likely to assume that the momentum or the strength of price coming in is not going to be too strong. And if we have, say, just wicks on either side, then it's pretty much showing you that there is not much, there isn't a deciding powerhouse that's in the market right now. Okay. So looking at wick rejections, okay, wick rejections are simply where we have multiple wicks at an area in the market, which is simply showing you where price is rejecting, okay, showing you the price is failing to push past. And I've basically shown you a bunch of examples at the bottom, and this is your like textbook wick rejections. If you're looking at something like this and you can clearly see it, then great. But if you're looking for wick rejections and they're just tiny, tiny wicks, then you kind of really need to be honest with yourself. Is this really a rejection or is it just a very small wick? Okay, that's what you need to understand. And the reason why this is important is because not only are they showing you an area in the market, it's not showing you an area of support or a level of resistance, it's showing you that this level is strong. Okay, it's a strong level. Okay, in my opinion, it's stronger than highs or lows or predetermined levels of support and resistance, because it's showing you currently the price is failing to push past. And why? Because it's showing you multiple times, okay, not just once, twice, maybe 3 or 4 times. Okay, in my opinion, 2 or more wick rejections for me is sufficient, but this is something that you'll be able to find out in your own learning. Okay, and at the last point is a little bit confusing, but I'll explain to you. It can be shown from present data and past data. And what I mean by this is, if we take a look at the bottom example on the left, we can see that if we are at the sort of far right side where price has tapped into that green box, we can see that price has already shown us that it's failed to break previously. So this is what I mean by past data. We've seen previously that there's a level in the market and price has now tapped into that level and then jumped off. Okay, but if we look at the example in the middle, this is where price has risen and we can see currently right now price is failing to break past that level. Okay, in my opinion, this is the more reliable one because it's showing you in real time. And the absolute best scenario is when you have a predetermined level and then price comes into it and then shows you wick rejections of that level. Okie dokie. Kind of literally following on from what I was saying, we're going to look at the uses of wick rejections. Okay, so since wick rejections show us where price is failing to push, this is going to give us some indication of where price wants to go. Okay, so the first example is where price is currently showing us that it's failing to go further. It's traveled down for a little bit, had a slight retracement to the upside, and then with those wick rejections, we can see that it's failed to break above, marked by that green box. Example 2 is where we found a pre-established area, and we're expecting price to bounce from this level. So as we can see in this example, price has pushed all the way down and it's shown us multiple wick rejections. We can see 1, 2, 3, 4 candle wick rejections right by there. And the whole premise of this is that we're expecting, as say, for example, you wake up in the morning and you see price has risen with that small green push. If we're coming back to this level, then we may want to take some trades by there. Okay, and example 3 is where we have a pre-established area and price is showing to break past that level. So this is the most reliable in my opinion. You've got a predetermined level and price is coming in and showing you with that example on the right that price is respecting it. We've got 1, 2, 3 wick rejections right by there and we're expecting price to obviously bounce from that level. Okie dokie. So just to finish off on wick rejections, obviously you guys have got your notes there. Definitely go ahead and research this kind of stuff, which you should be doing for everything. It may seem like it's a lot or may seem quite confusing, so make sure you're going at your own time. Okay, let's move on to push phases versus pullbacks. All right. A push phase is where price is currently pushing, and this is a very commonly used term by traders, and it's simply used to describe where price is simply moving with momentum. Okay, because price moves in all different types of ways, but when price is trending and it's going to key levels or it's going to make a new higher high or a new lower low, this is what's called a push phase. Okay, when we see price pulling back, okay, when we see, for example, if we're in an uptrend and price makes a slight retracement to the downside, that's called a pullback. Okay, and usually happens before price makes a new higher high or a new lower low. Okay, then I just included this example to give you an illustration of the push phase versus a pullback. So if we just look at the left-hand diagram, we can see that the push phase comes from where price is simply pushing upwards. We've got that slight retracement illustrated by the pullback, and then we're going to push again to make the new high. But obviously this is true for downtrends. It's specifically not just exclusive for uptrends. Obviously, it's true for downtrends, and we can see with the real example on the right, where we've got the push phase, we've got a pullback, and then we've got the push again. So why is this important? Well, it's important to note because you need to be able to understand where price is in its current movement. And there's obviously applications for everything in trading, but there's general rules which you guys should follow. And it's really not advised to be entering when price is in the middle of a push phase. Notice how I said in the middle of a push phase, because you're not really entering at an optimal place because price is already moving. Okay. And we'll talk about smart money and dumb money in a little while. A lot of traders will be seeing price move and they want to jump the gun and they'll be entering a little bit too late. The best places to enter are on the pullbacks. Okay, so where price retraces and look, then you can get a nice little discount on price, and you want to get in before the move has happened, so you're catching momentum. And I just included that last point there. Recognizing when price is in each state is very important for your future success. Trust me on this, guys. It's very, very important. It's going to be very difficult for you to not only see this in the real market, but then have the psychology to withstand from entering in a push phase. But this is a golden rule that I can give you, especially for you beginners. If price isn't pulling back or price is currently pushing and you haven't entered the trade, just leave it. Don't bother getting into it. All right, then we do have a video example here just to illustrate some things for you guys. I'm going to turn the volume up and just let this play. What is going on, everybody? Let's just go and consolidate everything that we've been learning. So let's quickly just talk about candle formation. So we saw in the beginning of this episode that candles have different shapes and sizes and they're all telling us a story. I just want to show you how, being able to decipher, what the candles are telling you is something that you can add a very, very powerful tool within your arsenal. Okay. Now, guys, this whole course and definitely this part of the video is going to be sort of paramount on your own learning. So the way that you look at these candles and how you look at them within your own analysis is going to be something that you will learn yourself. But just as a general exercise, let's go through this together. So look by here. You can see how we got this. Price was traveling down by here. We had this little bit of rejection, and then price had this big old rejection, and it even closed quite strong bullish. You can see how there was hardly any wick at the top, and then look what happened. Price made this push. Okay. So another thing that we can look at is where price is sort of failing to push past, right? We can see by here that there's this level of resistance, which has been marked out by, these wick rejections, this wick rejection, these are all highs. So as price is traveling up by here, we see this rejection by there. And we also see price make this candle by here. So sometimes you might see something like this, where it's kind of, the candles are basically telling you two things at the same time. It's like, so what am I doing by here? Well, as you gather the evidence, you'll be able to see, okay, we can see the next candle has closed strong, bearish, and we can see that these candles are pretty small, and then this candle looks like it's got a bit more momentum to it. So as you can see, price did sort of travel down by here after that initial rejection. Okay, let's go ahead and look at some other examples. Hopefully we'll look at some within the daytime, because that was in the middle of the night, and we're not really going to get a lot of information there because there's not much trading going on. Okie dokie. Right, if we look at this example, this is a great one, because we can see the price is basically showing very, very strong signs it's going up. We have these little pullbacks by here, but really, the pushes are coming from these big green candles. So you can see that we've got like no wick to the downside, no wick to the upside. We're just looking like we're just pushing. And this is also something very, very important. If you can see these three candles by here, these three green candles, you can see how they're increasing in price. Okay, this is showing you that there is momentum in the market. Granted, it didn't just keep on pushing, but then look what happened. Okay, we were pushing up and up and up, and then prices just keeps on going. It simply keeps on going until we get to, say, I don't even know, it's just going up and up and up. It's not literally not even stopping. So it does not stop. So yeah, if you're able to piece things together like this, you can basically, get some good information. Something like this, for example, where price has now pushed up for a little bit. We've got this slight rejection. Now we've got this nice big candle by there, and boom. So there are going to be times where you'll see these candles and, price will pretty much do the complete opposite. Like you'll see like a big green candle, then a red candle come down. Guys, this is just trading. You're going to get these awkward examples, but so long as you can take with the information I've given you and you can go ahead and look at price yourself and see how it, paints its story for you, then, like I said, you've got a very powerful tool in your arsenal. Okay, let's move on and look at push phases and pullback phases. So we were speaking about push phases and how you don't really want to be entering in the move, okay? So if you push phases usually, right, this part of the move is the push phase. As it pulls back, that's obviously a pullback, okay? That's the push phase, that's the pullback, but it's not always going to look like that. Sometimes it'll look like this, okay? Very kind of small, sometimes it'll be big. And sometimes the pullbacks might look something like this, okay? And then it'll start trending again. So what I'm saying to you with this example is that if you can see that price is pushing, so for example, if you can see like, you see this, okay? You don't want to be entering your trades by here, you don't want to be entering your trades by there, and you definitely don't want to be entering your trades by there. So if you can recognize, like if you see something like this, okay, where you wanted to get in on this move, but you haven't been able to, you can't just be entering, okay, right by here. Sure, if you find a strategy that works, fantastic, but when you see price pushing like this, especially when you see the increasing in momentum, you're going to find yourself in a sticky situation. So what you ideally want to do is just wait for price to exhaust a little bit. Okay, you can see now we've got these rejections. The candles are starting to get a little bit smaller. So this is looking like a place where you could potentially take some trades from. And something like this, guys, is much, much better. Okay, because what you're going to do now is you're going to catch the move before it sort of happened. When you're entering in the push phase, you're entering as it's happened, okay? So something like this is much, much better for you. And you can just sort of let the trade play out, okay? You don't want to be entering by here. You don't want to be entering by there. When you see prices like this, it's pushing, okay? When you see price pulling back, okay, it's pulling back. Now it's pulling back, okay? Now this is where you can start to make some decisions on where you want to be taking your trades. Awesome. I think we went over wick rejections, but let's go over that again. With wick rejections, it's quite interesting because there's going to be a lot of uses you're going to have for this, but I just think the most important one, 2 seconds, guys, my bad. Okie dokie. So what we talked about was that you are going to have situations where you will see price immediately show wick rejections, or you're going to take them from previous levels. So let's just go to the 1 hour time frame, because you can probably, you'll find these much more reliable on the 1 hour time frame or the 4 hour time frame. Okay, let's take a situation like this, okay, let's go by here, where you see multiple wick rejections. A few things you can do is simply wait for price to tap into here and then boom, go off. It doesn't mean that it's always going to happen. It just means that this is one of the uses for it. Another use could be, right, as you're seeing this kind of example, you're seeing, okay, I want price to get to a predetermined key level, and then I want to see some rejection. We see the rejection, then we get the push upwards. Okay, let's have a look. This is a good example of what I was talking about. If you notice, this is a key level right by here. Let's just go ahead and mark this out. So if you can see that we got wick rejections, wick rejections, wick rejections, and price was to leave this level, okay, and you can come back and you want to take some buys off it, you can see our price rises, come back, rises, Another thing that you could do, right, is that if you see something like this, okay, let's say for whatever reason you bought down by here, okay, and let's say you want to go for like a nice, one to say, let's extend the stop loss a little bit so we can say we've got a nice 1 to 3 target, okay? But you don't want to be in your trade if it's looking like it's going to give you problems. So this is what you could see. Okay. I can see that we've got a key level. I can see the price has reacted to it. Okay. I can see that we've now got multiple wick rejections at this level. Price has shown me for 3 hours that it does not want to push. So I'm going to go ahead and exit my trade. Okay. Another thing that you could potentially do, I don't know if this scenario would win or lose, but this is definitely something you could do. If you've noticed wick rejections, you could even just box this in by there, or if it's in tandem with a key level, it does not matter. You can say to yourself, well, do you know what? I can see the price is failing to push by there. So let me go ahead and mark my trade, and I want to go and take some trades, whatever, it pushed up, okay? Things you got to bear in mind is obviously where's the current direction, where's the trend, but using it like this, when you pair a situation like this with a bunch of different factors, for example, okay, I've got an uptrend, and I can see that we've got wick rejections down by here. Okay, I want to take my buys, and I'm going to use the wick rejections up by here to be able to cancel my trades, or maybe I can start to see some evidence that price is not giving me what it wants to give. There's a whole bunch of things you can use, but this is just a sort of your general practice. You definitely have to pair this in with your own learning.
Oops, Daisy. Sorry, guys.
Because, like I said, there's a lot of uses for wick rejections and push phases and candle formations, but it's really going to provide you with dividends when you pair it with your own learning and your own strategy, because it's going to work for some people, it's not going to work for other people, and other people are going to find ways to fit into their strategy where some people maybe just never need it ever, so it's definitely up to you. But I hope that was good for you guys, and you got a bit more of a general understanding of that in the live market. Let's go ahead and finish off this episode.
Episode? No, we're finishing off this particular part of the episode, my friend. Okay, then. So I hope that, as I said, I hope that guys provided you with a nice insight. Let's carry on and go to the next bit.
What is going on, everybody?
There we go. I don't know why it goes back to the same video when I press next. Okay, let's go ahead and look at patterns. Okay, the thing you guys have got to understand is that in Forex and trading in general is that there are thousands of patterns out there. Thousands of patterns that appear every single day in the market. And I guess the $1 million question is, which ones are the ones that you're going to use? Because which ones are the ones that are going to make money? The truth is all of them make money, right? But I would say that there are probably some that are better than others. But what's most important is their reliability and how they fit in with your trading style. So if you can find one that's pretty reliable and also fits in with your trading style, then that's going to be amazing. So as I said, it depends greatly on how you trade and what will work for you. But two typically reliable patterns that many of the community trading, a lot of traders recognize, and definitely myself, I use it every single day, are what's called double tops and bottoms, right? So it's double tops and double bottoms. It's like the same pattern but inverted. And then the break and retest pattern. So let's go ahead and look at that. So a double top happens when price will push upwards, it'll form a high, it'll retrace, and then it'll come back to that high to then go off to the downside, as you can see. And a double bottom is the opposite. Price will form a low, it'll retrace, and then tap back into that low to then push to the upside. Okay, the break and retest is a little bit more confusing. Essentially, it's where we have a level of resistance or support which gets broken, and then price comes and taps off that level. Okay, so when we have support that gets turned into resistance, this is called many things. It's called inversion level, I've heard people call it, and I don't even know what else they call it. But you can call it support turned resistance or an inversion level, and it's simply where price will break a high or break a low and simply come back to tap into that same level that it broke from to then push further. Okie dokie, so let's go ahead to the next point. All right then, so this is going to simply talk about the patterns.
Okie dokie, folks, let's go ahead and talk about those patterns. So there's two things that I want you guys to remember and reiterate is that we use patterns to either identify when we're going to identify when we're going to start to look for a trade, or identify when we're going to get into the trade. So there's specifically two things. So if we look at our double tops, okay, we can use this as an example right by here, okay, and we can say to ourselves, well, I'm going to look for double tops on the 1 hour time frame, and you can either enter on the 1 hour time frame, or for example, you could go ahead and maybe enter on the 5 minute time frame, look for some kind of a trend, and maybe you could hang on a minute. Price is coming down, okie dokie, and maybe you wanted to, enter your position a bit lower by here. But there's lots of different ways that you can go about using them. You can do the exact same thing with a break and retest. You can see on the 1 hour time frame you wanted to wait for price to get around this level, and then maybe you wanted to take some trades like on the 5 minute, maybe down by here or up by there. So as you can see, these patterns happen all the time, but it's just very imperative that you use it in the right context. And that's why I specifically chose these two patterns, because they happen literally all the time. Look, we've got a break and retest,
let me just get my thingy out. We've got a break and retest right by here. We've got a double top right by here. We've got a double bottom right by here. So it's just all about how you're going to start using them. Price broke out, we retested, right? What does it want to do now? Wants to keep on going, we get another double top. So these these patterns happen all the time. Do we get a break and retest by there? Not necessarily, no. And when we just to kind of reiterate this point of break and retest, okay? It's simply when price will break a level, and then we are going to now retest this level by allowing price to come into the zone, and then once it's in the zone, we're expecting it to basically do something like that. Okay, so it can kind of do it, a bunch of hoo-ha or whatever it wants to do before it actually wants to go down. And you guys are going to specifically identify when your levels are broken and when the retest comes. Some of you may want to extend this zone by here. It's absolutely fine. Some of you guys will say this is the zone, and maybe the retest will come as soon as you see something like this. Remember that episode we were talking about how you identify key levels? Just to remind you guys, for me, I identify them as when we get the bodies to the wicks. So as soon as price breaks below the wicks, that's it. I've decided that the level's broken for me. Okay, so what will happen if you get a break, but then you don't really get that retest? Okay, so we're expecting price to come up by here, and as you can see, it just doesn't, right? Well, guess what? You just don't do anything, guys. Quite simply. You didn't get your entry, okay? And that's that. We'll talk about entries in a little while. This is just for you guys to get your head around the notion. Let's just keep on going and see if we get any more, okay? This would have been a potential double top, but as you can see, price came down, came back up. We're expecting it to go down, but it just kind of shot up to the upside. What have we got here? Again, if you wanted to call this a double bottom, price came by here, pushed up, came back. Okie dokie. Price broke above, right? We can see price broke above, retested it by there. Now it's to do X, Y, and Z. I mean, I guess if you look at the 4-hour time frame, this could probably be a double top. So it's so versatile. It's so versatile, okay? And we're looking at the 1-hour time frame, but let's go ahead and just look at the 5-minute time frame. You're going to see this happen a lot more often. If we didn't even want to look at the higher time frames, we just want to look at the 5-minute time frame. What can we see that's literally right by there, right? We can see a break and retest that's happened. Price is going up and doing whatever. Okay, now it's breaking lower. Do we have a break and retest by there? We actually do. Why? Because price broke lower, tapped in, and now it's basically going down. So do we get a double top right by here? In some senses, I guess we almost do. There we go. Price is going down. Do you see what I mean? We're breaking lower. We get the retest right by here. So this happens all the time. Okay, towards the end of the course, we'll be looking at how you're going to piece your strategy together. But this is just an example. This is just how to show you double tops and bottoms and break and retest patterns. But obviously, if you guys want to study your own stuff, go ahead and do it. I'm just saying this is, some very reliable patterns that you can incorporate into your trading and be very versatile with them. Awesome. Let's carry on. All right then. So we're going to just finish off now with a little bit of information about indicators. And you heard me speak about them in the previous episode. I'm not the biggest fan, and I did put beware by there because, many people have, many traders recommend not using indicators. But if you guys did want to know about them, then I'm going to explain them to you because I told you that I'm going to be giving you all the information you need to go and base your own trades. I didn't say base the way I trade. If you want to go ahead and scout this out, it's completely up to you, but just be aware of it. Okay, so what are they? They are simply tools that you can find in a trading software. So if you go on TradingView, there's going to be loads of indicators there, and it's their job to give you some kind of an indication where price is going. The way that they give you this indication is sometimes through fancy graphs, through lines on the chart, like they'll add lines on there for you, or they'll give you simple numbers. A few examples that you could look at are EMAs, Bollinger Bands, and MACD. They're probably the most commonly used ones. They have their uses, but they're typically not recommended by many traders. And the reason why this is the case is because they are lagging, right? They tend not to give you a great indication of where price is going because it's always giving you the information previously. And let's be honest, do you want to get into a trade because a few lines on a chart told you? Or because this line crossed over here? Or because the MACD is doing this or diversions this or whatever? Or do you want to be able to actually read price yourself? So it's just a question. All right, guys, that's going to finish up for this episode. Hope you guys learned something. Drop a like, drop a comment if I was able to teach you something, and also hit that subscribe button, please. In the next episode, we're going to look at market structure. We're going to be using different time frames. We're going to look at the advantages and disadvantages of the higher time frames versus the lower time frames. And then we're going to be looking at an introduction to building your trading strategy. But thank you so much for watching. I'll see you in the next one. Take care, guys.